Everyone. Thanks for joining today. We're just going to give everyone a minute or two to get settled, and we'll start in just a moment. All right, and again, thanks for joining us today. Our webinar is titled Cross-Border Expansion Key Insights for 2025. My name is Katie. I'm a Client Service Coordinator here at the VSH office. It looks like we have a lot of people in attendance today, and we're really happy that you're all here. I just have a few quick reminders to review with you before we start the webinar. We want to be able to make sure we get through all of our material today while still addressing your questions. Because today's presentation is being recorded, we have turned off your video and audio for your privacy, and we will send you a link to the recording in a follow-up email. If you think of a question you'd like to ask, please use the Q&A button on your screen to share it with us at any time. If your question isn't addressed before the end of the webinar, please keep in mind that we will be following up with you directly via email. If you experience a technical problem or have a general question that is not related to the presentation, please send a message in the chat. All of the info I just discussed will be available in the chat during this webinar, and I will be pinning it at the top of the section for your convenience. And now to get started with today's presentation, I'm going to hand it over to Madison.
Thanks, Katie. If you want to move us forward in the slides a bit there. My name's Madison. For those of you online who I haven't had the opportunity of meeting, I lead our tax compliance and planning for owner-operated businesses with expertise in areas such as real estate, construction, manufacturing, restaurants, and hospitality. Speaking after me will be Suraj. Suraj works in our business advisory department, leading business transition planning, valuations, and advising clients in a lot of different industries. And then you'll hear from Tracy. Tracy leads our client accounting advisory department. She specializes in accounting efficiencies, transforming data into actionable insights, and supporting clients with forward-looking strategies for success. So our agenda today, we're going to look at 2024 year-end tax planning. We're going to look at leveraging financial data and automation for business success and go over business valuations. I'll go first with the importance of 2024 year-end tax planning. So looking forward on to 2024 tax planning is always important for businesses and for their owners, not only to ensure that we're in compliance with our ever-changing tax laws, but also to ensure that businesses are maximizing all the tax benefits that are available to them and that they have an understanding of the tax implications of their financial decisions. So as we prepare for the close of 2024, we pivot to looking forward into 2025. 2025 is shaping up to be a really big year for tax changes. We're going to walk through what we know to be true at this point in time, and I do recognize that it's a very uncertain time. So because of that, we'll also take a look at what we may expect to be true with some inevitable tax changes. Before we get into the detail of tax planning, I wanted to alert this group of a new reporting requirement that's due January 1st, 2025, that largely affects those in our audience today. In 2021, Congress passed the Corporate Transparency Act with an aim of targeting fraudulent shell companies and companies that may be using funds illegally. Out of this bill came a new requirement, the Beneficial Ownership Information Report, or BOI report. The report aims to collect data on who ultimately owns and controls a company, so many of you. The report is filed online through FinCEN, which is the Financial Crimes Enforcement Network. Companies with over $5 million in revenue and that have over 20 employees may qualify for an exemption from reporting. That may sound a little bit odd in that typically exemptions are designed to benefit small business. However, this is not the case here. The logic being that the larger a company is, the more likely that company already discloses the information that's being sought after through other bureaucracies. Any entity that registers with the Secretary of State may need to file this form, so it's not limited to just your operating companies. For example, it would even include if you had an LLC that owns your real estate, they would be subject to this filing requirement. There is a $500 per day penalty for noncompliance. However, even with this steep penalty and risk of non-filing, the FinCEN is reporting very few reports submit to date. So currently there's only about 6 out of an expected 30 million that have been filed. Because of this, it's possible that we could see a delay in the form due date if there ultimately isn't enough awareness of this filing requirement. However, at this time, the form is due January 1st. VSH has further information about who needs to file this form on our website, and we will link that page in our chat feature. And now we'll get into some tax planning. Next slide, perfect. A critical expenditure that we see for taxpayers across all industries is the use of depreciation, particularly in recent years utilizing bonus depreciation. Bonus depreciation is an accelerated method of depreciating your fixed asset purchases. Bonus depreciation has been declining, perhaps a bit quietly, over the past 2 years. It had been at 100%, dropped to 80% in 2023, down further to 60% in 2024. It is set to go down even further to 40% in 2025, and ultimately it would phase out entirely in 2027. 179 expense is still available to taxpayers and is another method for accelerating depreciation. However, 179 expense applies just a little bit differently than bonus depreciation. There's more limitations in its overall use. There's a cap on the total amount of expense that's available, so a taxpayer cannot exceed around 1.2 million of 179 expense in a current tax year. It also applies differently to real estate. So with these changes on the horizon for depreciation, taxpayers may want to consider accelerating their purchases by year end to take advantage of this higher bonus depreciation rate before we see a decline. Taxpayers may also want to consider their purchase choices altogether. There could be scenarios where leasing or renting is now more favorable to the taxpayer than an outright purchase. Taxpayers who own real estate, particularly commercial real estate, may want to consider performing a cost segregation. At a high level, a cost segregation aims to take the typical 39 or 27-year life of rental real estate and instead pull out non-structural components of that building for this quicker write-off to use bonus depreciation. With declining rates, we may see it beneficial to lock in your cost segregation for the 2024 tax year. Cost segregations are actually one of my favorite tax planning strategies because it's one item that you can still do after year-end close. You can perform a cost segregation actually at any point prior to filing your tax return. So in theory, if you wanted to stress out your CPA, you could perform one on April 14th. Slide, Katie. In 2017, Congress enacted what was said to be the largest tax reform in modern history, the Tax Cuts and Jobs Act, TICJA, as we call it in the accounting world. This act introduced a major tax overhaul. However, many of the items that were enacted were only set to be in place through the end of 2025. We refer to this as sunsetting. So if there's no action from Congress, these items automatically go back to what they were pre-2017. So I'll repeat myself because it's important. If there is no action from Congress, these items all instantly go backward. So we actually have to see Congress pass legislation if we want any of these items to remain. There's actually over 30 items in TICJA that are sunsetting, but we're going to take a look at just a few that I find to be most important. Ranking at the top of my list is the qualified business income deduction. The qualified business income deduction is a 20% deduction on your qualified business income. So that's income from your pass-through entities, your S-corps, your partnerships, your LLCs. It effectively reduces the top tax rate that you would pay on your business income from 37% down to effectively 30%. So if this provision were to expire, businesses would be taxed at a much higher rate starting in 2026. This could cause taxpayers to reconsider their overall entity setups, leading some taxpayers to maybe see more of a benefit if they were taxed as a C corporation. Another item subject to change is the SALT deduction limitation, state and local taxes. Taxpayers are currently allowed a deduction for what they pay in state and local taxes. So their personal property tax on your residence, any state income taxes, any state sales taxes. However, currently this deduction is limited to a maximum $10,000. This is set to revert back to prior to TICJA when no limit existed. We are set to see an increase in tax rates overall. So individual tax rates prior to TICJA were 39.6 was your maximum rate. TICJA lowered that down to 37, and we are set to see that increase back up to the 39.6% figure. I'll also note that TICJA set the corporate rate, so for C corporations, at 21%. This is not a sunsetting provision. It does not change. It is set to remain. The standard deduction was raised drastically, almost doubled under TICJA, and this actually caused many taxpayers to not see a benefit to itemizing, so really losing the benefit of their mortgage interest deduction and their charitable donations. This is set to revert back to pre-TICJA regulations, and the standard deduction would be much lower. So overall, there are big effects here that would impact small business and their shareholders. Another material change that's set to sunset, so material that it warrants its own slide here, is the reduction to the estate tax exemption. So currently a taxpayer may leave an estate or may gift away an estate worth almost $14 million tax-free. However, this amount is set to revert back to its pre-TICJA amount in 2026, which we would expect to be around $7 million. Because of this decline, there's been a really big push to take advantage of this increased value before it's set to expire. So there's a large emphasis to execute on any gifting plans before we see a decline in the exemption. The IRS has commented that they wouldn't claw back any gifts that were made in excess of a reduced threshold. Now, with the current election results, there's been a change in tone in that we can likely assume that this is going to be one of the top areas addressed by Congress. However, We don't recommend to stop your planning altogether, and rather we recommend that you just maybe plan a little differently than you would have before November 5th. It's important to keep planning for a few reasons. One, we ultimately don't know what the new threshold is going to be in 2026. Again, it's an item that sunsets, so we do need action from Congress to set a new amount. I wouldn't want to wager on Congress to act in a certain way. Another reason it's important to plan is that Washington State has its own state level estate tax with a much lower taxability threshold. And three, another reason not to delay is if we do ultimately see a decline in this threshold, we want to circumvent a bottleneck in legal services and executing these gifting strategies. A lot of these gifts require evaluation, which Suraj will touch on next, and we want to allow plenty of time to act accordingly. So we recommend a focus on planning and a consideration of all a taxpayer's long-term goals. There's ability to gift to certain trusts where the taxpayer retains or their spouse retains control of the underlying assets. Depending on a taxpayer's situation, there could be other reasons where gifting may still be attractive at this point in time. If a taxpayer owns assets that are likely to appreciate in value, it could make more sense to remove them from the taxpayer's estate right now. There are high expectations now for the stock market over the next few years, so it's possible we could see an increase in removing some securities from taxpayers' estates. VSH works primarily with growing business owners, so we often see consideration of plans with their business stock. And Suraj will speak after me today about how we value this business stock and plan for its transfer, but just keep in mind that it all ties back to your estate planning. So what can we really expect on the horizon? There is a very high likelihood of significant tax changes in the near future. So likely that the accounting profession is calling it our tax Super Bowl or Tax-mageddon. We really should not be allowed to make jokes as accountants. But we do expect there to be material changes. Not only is there a new president and new Congress, which automatically sets a tone for legislative action, there's also all of these expiring provisions. Absent any change from Congress, the tax code would really regress back 8 years come January 2026. There will be immense pressure for Congress to prevent this from occurring, and ideally we would see it occur prior to when all these provisions actually expire. However, that's not guaranteed. We still could see some gridlock and some delay. Even with one party controlling all of Congress, there are still budgetary requirements that have to be fulfilled. So you may be quick to say, well, Madison, can't we just assume that the party that wrote the tax code in 2017 is writing it again in 2026. Won't it be exactly the same? And I don't think it's that easy. It's doubtful that there will be an automatic extension of every single provision. Additionally, we've seen some new tax provisions thrown around based on campaign promises or new areas of interest. And all of these items come at a cost. So if we're going to see new tax provisions, we may assume that other tax provisions could be lost. And one more slide, Katie, perfect. Without knowing what the future holds, my takeaways are to stay informed. Uncertainty can make tax planning really difficult. However, we never recommend staying idle. You want to be ready to pivot whenever legislation is known. Continue to review any tax law changes and be ready to adjust your strategies accordingly. Communicate with your advisors and stay abreast of any changes. And with that, I'm going to hand it off to Suraj.
Thank you, Madison. Hi everyone, my name is Raj Saul. I'm the Business Advisory Manager here at VSH. I have my CVA, stands for Certified Valuation Analyst. This allows me the opportunity to specialize and lead the business valuation team here. First off, thank you to everyone that is listening in and joined us this morning. The goal of today is to be educational and talk through some of the analysis we do when doing a business valuation, and then also touch on what that would look like if you're planning to take the next step and ultimately sell or transition your business. So first slide here, agenda, that's more or less what I just covered. So next slide, Katie, please. First things first, what is a business valuation? Well, it is simply the process of determining a company's economic value. So in short, it is what a business is worth at any given point in time. So you can imagine a buyer or prospective seller's opinion may differ greatly on that. So why is it important to know what your business is worth? Well, we have sunsetting tax provisions, effectively meaning they're set to expire, which Madison did a great job explaining and alluded to. So where currently the limits for estates are double the usual amount, meaning there's no better time to gift shares of a business. Also, economists are predicting after years of high rates, and now that the Fed rate cuts have started, we are going into an overall hotter market. So lower borrowing costs can help increase the amount a prospective buyer may pay for a company or business. When we are doing a valuation of a company and looking at the income approach specifically and building out a discount cap rate, one of the aspects of our calculation is looking at borrowing costs, interest rates, and the role they play. Two key aspects of every business valuation, as mentioned on the slides, are the date and the purpose. So if we were to work together in valuing your business, these would be the very first questions we'd probably ask. Based on the purpose, we decide what type of value we would be using. Two typical values you see are fair market value and fair value. It is important to note fair market value, FMV, is required if the valuation is for tax IRS purposes. FMV allows for some discounts, which we'll touch on in a little bit. Some different potential purposes for evaluation and why you would engage in getting a BV done can be a multitude of reasons. They're listed here. So succession, transition planning, estate and gifting, buy-sell agreements, divorce settlements, acquisition, etc. There's more listed. In evaluation, we have three approaches we're looking at. So these three approaches are market, cost, and income. So the market approach is we're looking for a comp comparison, similar size business in the same or nearby location, industry, etc. This can be thought of and similar to real estate terms. An example being if you're listing your house, you may look at what a neighboring house sold for that was built around the same time, same square footage, etc. Next, we have the cost approach. It's also commonly referred to as the asset approach. This is popular for a highly capital-intensive business. So if you have a lot of fixed assets in your business, or if your business isn't generating as positive a cash flow, we look at the fair market value of these assets. And then lastly, we have the income approach. Here we look at the last 5 years of financials, tax returns, as that encompasses a full business cycle, the ups and downs. Some income approaches result in calculating EBITDA, which you may have heard of. That stands for earnings before interest, taxes, depreciation, amortization, and multiplying that by a cap rate, which encompasses certain risks and rate of return an investor would be looking for. This is also a similar idea or concept of using multiples, which commonly get thrown around. So a company, say, is worth 5x, well, 5x EBITDA or other recurring cash flow. We'll also look at discounted future cash flows. It's important to note the value of a business is not in historical, but what the company will do in the future. So that's where industry analysis specifically can be very important. On the next slide, we highlight two discounts that I briefly just want to touch on. First, a discount for lack of marketability. This is a reduction in the value of a private company share. So a company that isn't publicly traded, this reflects its limited marketability. this can be seen that you can't just go and sell these private shares on, say, the stock exchange. Second one, a discount for lack of control, is also known as a minority discount, or 50% or less ownership. Minority shareholders don't have the same influence over a company as a majority shareholder. So minority shareholders can't make decisions such as declaring dividends, distributions, setting policies, determining compensation, and selling or liquidating the company. So as you can imagine, these discounts can result in a lower valuation. But the reason I wanted to mention these specifically is the interplay with what Madison alluded to, is there can be a potential benefit. For example, in estate planning gifting, as there is a limit on how much you're allowed to gift, or if your estate reaches a certain point, the level at which you'll be taxed. So it's also important to note business valuations are attached with those subsequent tax returns and subject to IRS review. We also have listed on the slide some of the adjustments that we commonly see when we're doing a valuation. These can be for non-operating assets, non-recurring or discretionary expenses, an owner's salary versus distribution, if it's an S corp, and taxes. The last point on business valuations that I want to really touch on, and it's an important one, is there's two ways to increase the value of your business. It's increase the profits, cash flow, or secondly, decrease the risk. The risk component we're going to touch on the following slides as we shift to talk about exit planning. So after calculating the business's value, the next step in a lot of these cases is working to transition the business. This is referred to as succession planning, aka transition and exit planning. The infographic on the slides points out 6 steps. It's in clockwise rotation starting from the top. First one there is identifying owner's objectives. So this is, what is the owner wanting to achieve with the sale or transition of the business? Are they wanting to retire? Maybe do something different? Is it health related? Also, do they want to maximize every last dollar in a sale, or perhaps do they want to take care of employees? They care about the culture if they were to exit. So these are all important things to identify first and foremost. Next would be identifying the exit timing. So ideally, believe it or not, you'd like close to 5 years because to exit a business, because it's common that an owner starts to navigate exiting the business, but then must go back in the cycle for different reasons. We obviously have had a lot of business owners exit in much less time, but the earlier you start thinking about this, the likelier you are to maximize value and have a favorable exit. Third is determining BV, business valuation. This is what we kind of touched on in the earlier slides. So getting a real solid number for what the business would be worth going into negotiations. Fourth, we have personal wealth and estate planning. This is where we ask business owners if they are working with a financial planner or questions about retirement. If so, we might come to the conclusion that there's a potential value gap. That is the amount that they need to retire versus what the business is worth after accounting for all other personal assets that they own. And if it leaves them short, it results in a prospective gap. At this point, a business owner may choose to work a few extra years to make up the amount, or try to increase profits, decrease risk so that the business is more valuable. Fifth, we have maximize and protect business value. This is key to the risk mitigation. Some examples are having key management in place, making it so the business isn't solely reliant on the owner or owners. This can be from the perspective of vendors, clients, employees, and relationships, and ultimately who's bringing in business, refer to rainmaker, etc. So lastly, as we work through those steps, is business sale and continuity. So final step, ultimately, let's say a deal is reached after negotiations, due diligence phase, and the business is sold. Typically, new ownership is going to want the outgoing owner to stay on for some time to train, as well as transfer those relationships, customers, clients. This can sometimes be referred to as golden handcuffs, as there may be a heavily incentivized compensation plan, or part of the deal is an earnout, or there's other deal structure that results in this. So on this next slide, I wanted to highlight just 3 headers. These are know your worth, build your team, plan for the future. These are 3 key steps in transition planning. As I mentioned in the middle, it talks about inside sale versus outside sale and how these may look very different. An inside sale is where you're transferring ownership to current employees or perhaps a family member. Meanwhile, an outside sale is selling to a third party. This could be another local company looking to grow their presence or strategic acquisition. It could be an investor, it could be private equity, so on and so forth. So depending on what the owner's objectives are from the previous slide, that first step, the type of sale they might look at going inside versus outside could differ drastically. So this is something to start thinking about now as you look forward to your exit. If there is someone you have in mind that might be a good fit, even if with outside sales, I know business brokers typically ask the owner if they've had conversations with other companies that may be interested. On the flip side, if you're looking to acquire a business, it wouldn't be a bad idea to have a conversation with that business owner, even if it may look like they're years away from potentially retiring, so that they're aware of your interest. This can be similar to telling your neighbor that you're going to buy their house one day if they ever sell. Another important aspect could be if it's going to be an asset sale or a stock sale. This is either where you sell the assets of the company or you sell the company's stock. Both options have different tax and legal consequences. This is something we look at closely when calculating an owner's take-home cash. So this is the money that they will put in their bank account ultimately after paying for applicable fees, commissions, taxes, etc. Taxes are by far the biggest chunk here, so it's very important to tax plan with your tax advisor. So lastly, we have the tips and takeaway slide. So I'm going to read these 3 off. 1 out of every 4 businesses that seeks to exit sells. So what does that mean? A lot of businesses are just closed up or liquidated. Secondly, a 5-year runway, as we touched on, is ideal. That means even if you're not planning to exit or retire for a number of years, it's good to start thinking about this at least. A business valuation is an important step. It will let a business owner know what the company is worth today. They can plan accordingly, identify a value gap if it's present. It's really common where we will do multiple business valuations for a company. For example, do one today and then update it again in say 3 to 5 years because values have changed. And then work with a trusted business advisor to mitigate buyer-seller conflict. We at VSH offer this for our clients and business owners. We'd be happy to jump on a call and discuss this further with anyone that's listening today and share more. And with that, I'll pass it on to Tracy. Thank you.
Thank you, Siraj. I'm going to be talking today about how you can leverage your financial information and plan for business success. If we look at the next slide at the agenda, we'll be looking at how you can keep your financial information updated so that you'll be looking at real-time data and how you can add automation to your financial processes to achieve this. We'll look at how you can help run your business using analysis of your information for things like cash flow management and budgeting. And we'll look at a case study of how we've worked with one of our clients to update their processes. So on the next slide, oh, you're ahead of me. Using a program like QuickBooks Online allows you to use the bank download function so that you've got up-to-date information at all times. The traditional bookkeeping model has a month-end close, which gets completed 1 week or up to 3 weeks after the end of the month. So when you're looking at your financials, you're looking at reports that are up to 7 weeks old. On the other hand, when looking at data that is up to date, you can better assess what's happening in your business right now. It can help you make decisions about what is selling, what needs to be ordered, what adjustments are needed in regards to staffing, among other key issues. Accurate, up-to-the-minute information helps you manage your planning to match up with what is currently happening. Automation goes a long way beyond bank downloads, and we're going to look at 3 important areas: accounts receivable, accounts payable, and payroll. QuickBooks Online has basic versions of all of these functions. You can also go to an outside vendor that's going to have a lot more robust features. A good starting place for most businesses is to use what's available in QuickBooks Online. And then as your needs increase and you want more specialization, you go to these outside apps for additional features. There are thousands of apps that synchronize with QuickBooks Online for all kinds of functions. Accounts payable, accounts receivable, payroll, as well as sales tax, inventory, and all kinds of planning and advisory tools. In the accounts receivable space, automation allows invoices to be created, sales tax to be calculated, and the invoice being sent straight to your client all in one step. There's no need to send a separate email through a different program. Invoices go out directly to your client and a link is provided so that they can click to make payment via ACH or with a credit card. It has been shown the easier it is to make payment, the sooner people will pay, so your accounts receivable aging will decrease. Automatic reminders are emailed out, so you won't be spending your time chasing down late payers. Automated reports make it easier to see when clients are falling behind in making payments. Accounts payable automation is an area of huge gains in accuracy and time savings. Instead of opening envelopes and manually entering bills, technology exists that will read a digital copy of the bill and enter all the information into your accounts payable system. No typos for manually entering information, just an easy list of payments to review and accept. Your vendors will be happy to set you up with their payment information because from their point of view, if it's easy for you to pay them, then you'll be paying them faster. We recommend that all clients do some sort of automation with their payroll. With the complexity and penalties that can be assessed for doing something wrong, outsourcing to a professional provider is a really great idea. On the employer side, there is still some automation that can be used. For instance, there's a ton of apps that syncs with QuickBooks or Gusto, Paylocity, whoever your provider is, that will allow your employees to have digital time cards. These can be on their phones so that as they're working throughout the day and maybe traveling, they can keep track of what they're doing and where they're doing it, so you won't be chasing down time cards at the end of the week. So let's look at one of our clients that we have done some of this automation work for and some simple planning tools to improve outcomes. We have a client whose in-house accountant was retiring and they were looking at replacing that person or going to an outsourced provider. Their pain points were having to find a new employee, who was going to manage this new employee, getting the new person trained, creating a set of office procedures so that the new person would have something to follow, and then communicating the final information to the owner in a way that was useful to him as far as making business decisions. Note that having an in-house bookkeeper is great for keeping the bank reconciliations done, but very few bookkeepers can provide insight into the numbers. We met with our clients and it was agreed that we could help them move their business forward into more automation and not have the need for an in-house staff person. We started by moving them from QuickBooks Desktop over to QuickBooks Online. This allows for more than one person to be working on the file at a time. Multiple people can access it from the office, from home, from their phones, and easily access it when traveling. Plus, it's easy for us as the accountant to access it from our offices. The first step was getting all the downloads working from the banks and credit cards so that all the information was flowing into QuickBooks Online automatically. No risk of manual entries having typos or being done incorrectly. When we start analyzing the numbers, we know we're working with reliable information. Our next step was accounts payable. When we started, we were writing something like 35 paper checks a month. And again, there's room for error when you're doing that kind of manual entry. It takes a lot of time to be generating, printing, signing, and mailing off all those checks, so we automated it. We looked at Bill.com and we ended up automating it through QuickBooks Online. It took a few months, but now we have all the vendors emailing their bills to a centralized email address. These automatically get uploaded into QuickBooks Online, and we quickly review them to make sure everything uploaded correctly. Plus, we have set up notifications that help us determine if there's any funny business going on or if anything looks fraudulent. Our client reviews the payables list to make sure that all the bills are legitimate. Almost all bills are paid through QuickBooks Online, so we get them entered and classified correctly, approved by the client, and paid in record time. We've taken a process that took approximately 10 hours a month, and we've brought it down to around 2 hours. Our client already had good processes and people in place for doing accounts receivable and payroll, so our next step was using all of this solid data to provide information that he could use for making business decisions. Let's look at some of the basic reports beyond the balance sheet and the P&L that business owners can use to understand their business progress better. So there we go. So cash flow management is an area that can have a big impact on your business. The uncertainty of whether or not there's going to be money in the bank in 3 weeks or in 3 months to meet the needs of the business can be unsettling. Having a plan for your cash flow allows you to make better decisions for your business, including when it's a good time for new purchases or to take on new employees. Knowing your cash position, and especially your cash projections, informs decisions around taking on additional debt to finance expansion, or it can let you know the best time to take money out of the business for your own personal use. Budgeting is a powerful tool for a business that is growing. It allows you to look at historical information and plan for increases to revenue and to plan for increases to the corresponding expenses. Expenses that will remain constant regardless of increased revenue, things like rent and utilities, can be accounted for so that we can really dial in what the expansion is going to look like. Another benefit, having a budget makes it easy to see when an expense is extraordinary or unexpected. Our client was interested in growing the business. We did some cash flow analysis to aid in planning for expansion and provided some visuals that gave him a picture of where his business stands in comparison to the prior year and in comparison to others in his industry. We created a budget and a cash projector so that he could plan for growth and be alerted to times when there was going to be a cash crunch. Knowing ahead of time allowed him to plan expenditures and financing before running into problems. Having solid information and having it organized in a way that gives insight into what's going on is essential to making powerful decisions when running your business. Once you develop a relationship with a trusted advisor, they will start to understand your business model and your business plan and can add more specialized reporting. Here's some other additional reports that can be valuable in providing insight into your business. We look at things like ratio analysis, so tracking year-over-year numbers and tracking the budget to the actual. We look at your working capital, the amount of your current assets minus your current liabilities, and this can gauge the short-term health of your business. We look at debt to equity ratios. This measures the degree to which a company is financing its operations with debt rather than with its own resources. We look at debt servicing ratios. This measures a company's leverage and therefore its attractiveness to a lender. And then there is some scenario modeling. And this is where we can get into some of the really fun what if questions. What if we increase revenue by 20%? We can run scenario modeling that will show what that's going to do to your other numbers, and it's going to help you know when you're going to need to increase staff. It helps to know when is the right time to take on debt and when cash is going to be available to purchase new equipment. So I've touched on some of the early steps in data-driven decision-making. There's no end to the analysis that we can do with financial information. You can advance the slide, Katie. More and more tools are being created all the time to help business owners understand what their numbers mean. We advise you to reach out to your trusted advisor today and find out what we can do for you. So Katie, I think you're going to take it back now and see if we have any questions that have come up.
All right, thank you, Tracy and Suraj and Madison. That was a great presentation today. I'm going to take a moment to share a link over in the chat to ask that you provide us any feedback, answer these 3 quick questions that will allow us to provide you with useful and relevant content for all of our future webinars that we might do. And Madison and Suraj, I believe that we had a couple of questions that came in prior to the webinar starting. Would either of you like to take the questions?
Sure. Do you have them in front of you, Katie?
Yeah, the first question was from somebody who wanted to ask what steps they needed to take in order to start gifting property to their 18-year-old.
Great question. And I hate saying that it depends, but it a little bit depends. We would ask you follow-up questions such as, you know, when do you want your daughter to have control over the property? Is she ready to have control of the property now? What are your long-term estate planning goals? Are you ready to let go of this property? Is it still producing an income for you? And then we'd get into some of the tax logistics and legal logistics of executing that gift.
Thank you for the answer there. And the second question.
Katie, can I chime in real quick? Yeah, what Madison alluded to was exactly correct. The only other aspect I would want to just touch on is besides just federal taxes, there would be potential other type of taxes in play, such as, you know, excise, real estate excise taxes, which can range from 1% to 3% as well. So when property is in play.
Thank you, Suraj. That second question is, will the concept of UBIA be obsolete once the provisions of TICSA sunset in 2025?
Yes, that is a concept that's tied to QBID, that qualified business income deduction. So all tax law surrounding QBID would be obsolete unless we see an extension.
All right, we just have a question come in for Tracy. Tracy, are you seeing an increase in adoption of QuickBooks Online over the past few years? I have not heard many bookkeepers like the online version of the software. What are your thoughts?
I am definitely one of those people that took the last 20 years to get one over to QuickBooks Online, but QuickBooks Online has finally actually won me over. They keep on upgrading and making improvements, and they are the industry standard at this point. There are plenty of accounting offices that will not work with you if you are not set up on QuickBooks Online. So it is definitely improving as time goes on. It is the industry standard. As I mentioned in my presentation, there are so many apps and so many other inventory and payroll and bill paying providers that sync with QuickBooks. That being said, QuickBooks Online is not for everybody. If you have strong inventory needs, there are other softwares that are probably going to serve you better, or at least you're going to want to outsource to an app that will sync with QuickBooks Online. In particular industries, retail, food service, construction, there again are specialized softwares that are going to meet the needs of your business a lot better than QuickBooks Online is going to. Also, once a company reaches a certain size, I think that there's other products available by other software providers that just based on the size of the business are going to be a better fit than QuickBooks Online. A lot of what we see with our clients are medium to small, big companies. So QuickBooks Online does meet the needs of most of our clients, and it is our preferred platform for a general ledger system as well. Thanks, Guy.
Thanks, Tracy. And another question here for Madison. The question reads, can I do a cost segregation on a building I purchased in 2019?
Yes, you can. So not only can you take advantage of a cost seg after year-end close up until the due date of your return, you can also do it on a building that you've already placed in service. The longer it's placed in service, the less benefit you're likely to see, in that we have to do a true up of depreciation you've already taken compared to this accelerated amount we would take, but it is still an option.
We don't see any other questions that have come in the chat. And it looks like we got to all the ones that were asked ahead of time. If anyone else has any other questions, you can click the raise hand button if you're still typing to let us know. All right, looks like we're all set then. Again, I just want to take a moment to thank everyone for joining us today. I have left that little form questionnaire in the chat that will only take 1 or 2 minutes for you to complete, and we really value your feedback. We appreciate you joining us. We'll keep you in the loop for any future webinars that we will sponsor in the future. And thanks for joining us. We hope everyone has a great day.
Thanks, Katie.
Thank you.
Thanks, Katie.